what we discussed so far in accommodation. So just in case some of you have joined now, for the purpose of accommodation, it's a very, very important rule. Accommodation is something which comes along with either this or HRA. One of them normally comes in salary. Either HRA or RFA are very, very important. So for the purpose of value of accommodation, so we have to first classify like any other provision, government employee, non-government employee, furnished, unfurnished. First, we have to see unfurnished. Unfurnished accommodation will depend upon whether the accommodation is owned by the employer or taken out rent by the employer. If the accommodation is own accommodation, the valuation is going to be based on a percentage of salary. 15, 10, or 7.5% of the salary will be taxable depending upon the population. If the population exceeds 25 lakhs, 15%, 10 to 25 lakhs, 10%, up to 10 lakhs, 7.5. As already mentioned, if it is exactly 25, it will be 10%. If it is exactly 10 lakhs, 7.5%. For leased accommodation, population is not the criteria. So for leased accommodation, rent or 15% of salary, whichever is less, will be taxable. For government employees, the valuation will be as per the government rules. The most challenging part of it, the most important part of it in accommodation is the meaning of salary. Generally, salary is basic plus DA plus commission if based on fixed percentage of turnover achieved by the employee. However, four places where the salary is not this. One, specified employee, gratuity under POG Act. Third one is entertainment allowance, only basic. Fourth, and the most important, frequently in the examination, but the salary is not basic plus DA plus commission, is RFA. Everything will be a salary, all monetary payments except DA, PF contributions, and value of worksits. Just make a note of it somewhere in your notebook. A lot of times you have seen in the examination, this point has not been factored at all. So RFA, the most important provision where salary is not basic plus DA plus commission. It will include everything except the three. Exceptions is something which we have to take into account. So arrears of salary and advance salary are not going to be considered because you have to take the salary only for the period for which accommodation is given. Arrears of salary will be taxable if it pertains to the earlier years under 15C, and advance salary will be taxable under 15B. Both will be excluded for the purpose of accommodation, which is a very important point from the examination point of view. Now, similarly, if accommodation is provided for say 3 months, from January to March, we should take only that 3 months salary for the purpose of valuation. So next comes the furnished accommodation, accommodation concession rates. Furnished accommodation start with unfurnished, add 10% on straight line method for depreciation if the furnishings are owned by the employer and the furnishings are taken on lease by the employer, take the actual hire charges. If you add the two which are given in step 2 and step 3 to the step 1, which is the value of unfurnished accommodation, you're going to get the value of furnished accommodation. Accommodation concession rates just needs only one modification. Take as if you are given free of cost. From there, reduce the rent paid by the employee. That will give you accommodation at concession rates. If the accommodation is provided in two places on account of transfer, up to 3 months, value both, take the least of the two. Beyond 3 months, take both and value both and take both. Accommodation in hotels will be subject to a high rate of tax, which is 24% of salary, or the rent paid, whichever is less. However, nothing will be taxable if it is provided for a period of 15 days on account of transfer. And the last but not the least, the valuation of Rule 3 will not apply if the accommodation is provided in a mining site, an onshore exploration site, or any project execution site or offshore site of a similar nature in a remote area. So that's about accommodation. As I said, it's a very, very important rule. Maybe in the next session, we'll work out problems on accommodation. So we have done with rule 3.1, 3.2, 3.3, 3.4, 3.5, 3.6. So 3.1 already said has to be linked with 17.2.1 and 17.2.2. 3.3, 3.2 to 3.6 has to be linked, as we already discussed. So it has to be linked with rule 17.2.3 and 17.2.4. Only one point which needs to be noted in the case of valuation of motor car, if instead of giving a car, so if the employee is given any other mode of conveyance, then What is the equation is there? So that is given here. You can just go through this particular point. Very rarely this comes in the examination, but however, so in case if it comes, you can just have a look at it. So not that important. So I'll just now move to 17 to 8. 17 to 8 provides for value of fringe benefits provided. So value of fringe benefits provided that may be prescribed. So rule 37 describes the value of fringe benefits. This is something was introduced in the income tax rules from 1st April 2001. Now, why it's from 1st April 2001 is that post 1991, when the economy is liberalized, a lot of multinational companies came to India and established their offices here. So when they set up businesses in India, they also brought some of their employee welfare purposes schemes to India also. So these purposes are not known to India pre 2000, pre 1991, only when the foreign companies came here and made a strong foothold. They also want to bring in certain benefits which they were trying to give internationally to their employees. So that is why these rules were introduced from 1st April 2001. Some of them are very interesting and very important. So first and the most important is interest-free loan or at a concessional rates. So normally, an employee in, especially in foreign banks, so they will be given housing loan at 1% or 2% simple interest. So now, as all of you, if by chance read financial management, you'll be know about one particular point. The interest rate depends upon the nature of loan, and it is also based on to whom it is given. For example, typically a housing loan attracts a lower rate of interest when compared to a personal loan or a credit card. So credit card will have the highest rate because the possibility of the amount not being paid are very very high. So therefore the rate of interest charge is pretty high. Similarly, personal loan, the rate also will be very, very high. But whereas housing loan will be cheap. So even within these loans, depending upon the risk profile of the borrower, for example, if I want to take a personal loan, possibly I may get at a much lesser rate than what most of you can get. The reason is by seeing my returns of income and my income, the banker might think the personal loan to me is not as risky as a personal loan to you, but since none of you are actually working. So therefore, these rules, when they were not there in the income tax rules, we used to easily defend this particular case by saying that what interest to be charged by the employer to the employee depends upon the risk profile. Generally, I don't find any risk in lending to my employees for a very simple reason. Their PF is with me, their ESI, their ESI benefits with me, so their gratuity is with me, their leave salary is with me. So I'm completely protected because of the fact their lot of their benefits are in my hands. I can anytime recover. Therefore, I used to tell I don't have to charge high rate of interest. So since the rate of interest depends upon the profile and the type of loan, this is one easy escape route for not taxing the same. So therefore, Rule 37 specifically provides this is the rate an employee should charge from the employee. So what is that rate? The rate that should be charged by the employer for the purpose of this particular rule is the rate charged by the State Bank of India for a similar loan as on the first day. So we just need a lot of points need to be noted. State Bank of India, sheer size, they are the largest bank in India by a big distance. The second bank in terms of deposit loan size are far behind. So, but you have to take SBI for similar loan because you cannot compare a housing loan interest with a personal interest. Therefore, you should take the rate of SBI for similar loans. That means if an employee is given housing loan, you should take SBI housing loan interest on 1st of April. If the employee is given a personal loan, you should take SBI personal loan as on the first day of the previous year. What is very important to note here is that irrespective of the date in which the loan was given, the rate has to be taken only based on first day of the previous year. The logic is very simple. We all know that TDS has to be deducted by the employer. So you cannot have a situation where you take rate of interest of SBA as and when the loan is given will make it extremely difficult for the employer to follow the rule. In order to make it simple, take SBA rate as on the first day for similar loan. That should be the rate of interest charged. If the rate of interest charged is above SBA rate, nothing will be taxable. If the rate of interest charged is zero or is lesser than the SBA rate, the difference will be taxable as a perquisite. So therefore, benchmark is SBA rate as on the first day, compared with what is interest charged, difference will become taxable. What if some amount is recovered from the employee either on a month on month basis, because we already talked about at the time of discussion of 24B and 80C, the concept of EMI or equated monthly installment. That possibility is also there. That could be recovery from the salary of the employee month on month basis, or the employee may also request, instead of recovering on a monthly basis, I'll pay once in 6 months or once in a year. It is depending upon the arrangement between the employer and the employee. So maximum outstanding monthly balance is to be used as a basis in case some repayments happen. So 9 out of 10 exam problems, no repayment will be given. Answer is easier. Take for the full year. But suppose if there is some repayment is given, you have to go by the maximum outstanding monthly balance, which is defined in the rule as the aggregate outstanding balance for each loan as on the last day of each month. So that's a very interesting point. Let's assume I taken a loan of 10 lakhs and I repaid on 15th of October 2 lakhs. No interest is charged by the employer from me. 10 lakhs starting loan, 2 lakhs repaid on 15th of October. SBA rate is 10%. For some very strange reasons, most of the students' examination calculate 6.5 months on 10 lakhs, and on 8 lakhs, 5.5. So October 15. So you take 6 months of September, 15 days of October, 6.5, then 5 point. This is what people do. I've told so many times in our income tax discussion, income tax cannot be done accounting way. This is completely different. Either we take it or we don't take it. Just recall this point we observed at the time of motor car when we added situation 5. Originally, there were 3 situations. The problem we had the car can be also used for office to residence and back. Then, in that situation, we added what will be the answer if it is provided from January 15th. Just recall. So, if in that particular case we made observation, somebody gave an answer of 3 months. I told him it's a good answer, though it's not a correct answer. Either it has to be 2 months or 3 months, it's a good answer. 2.5 is a bad answer. Now, similarly, in this particular question, if I say repayment is on 15th of October, I don't mind you taking 6 months, or 7 months, 5 months, not a problem. But if you give 6.5 months an answer, you're not coming out of the first examination, which is accounting. Exam number 1, accounting, exam number 5, accounting. Tax is sandwiched between the two. Tax don't do like accounting. Forget accounting, will come to tax. Here, the rule itself very clearly specifies the maximum outstanding monthly balance means the aggregate outstanding balance for each loan as on the last day of every month. That means if I repay on 15th of October, for the month of October, I should take what is the balance as on 31st of October. That means repayment of that month, whether it is on 1st or 31st, will be considered for calculation of interest. That means what you should do in this question for 10 lakhs, 6 months, 8 lakhs, 6 months. It is not 6.5, 5.5. It's going to be 10 lakhs, 6 months, and 8 lakhs 6 months. Why? You have to take the calculation of interest based on amount outstanding as on the last day. This is the rule. Plus, in order to ensure that the small employees are employees in the lower part of the pyramid are not affected, first bullet point: if the amount of loan to the employee does not exceed 20,000, this rule will not apply. So normally, what happens? My driver comes during the month, during Diwali or Pongal. Sir, bonus. Next, sir, give me some advance. You can deduct in the next 6 months. எவ்வளோடா வேணும்? Sir, 5,000. Now, should I have to charge him? Rule 37 Percocet? The answer is no, because if the loan does not exceed 20,000, nothing will be taxable. Now, similarly, if the loan is for treatment of certain specified diseases, which we already discussed at the time of 80 DDB, and the amount is not reimbursed to the employee under any medical insurance scheme, then nothing will be taxable. So, two exceptions are loan not exceeding 20,000. Loan is for the purpose of prescribed diseases which are there in 80 DDB, provided there is no insurance reimbursement for that. So, this is about Rule 37. So we'll just move to another very important one, which is perquisite in respect of transfer of movable asset and use of movable asset. I'll go to use of movable asset first, which is more easier. So use of movable asset. So what is the difference? The difference between use of movable asset and sale of movable asset is, in the case of use of movable asset, I give the asset to you when you can only use it. When you leave the company, you have to give it back. In the case of transfer of movable asset, so what will happen is that the asset is yours. You don't have to return even if you leave the company. So, for example, if so, we give laptop to our anybody working in the office. So we have to next find out what they should do when they leave the office. Should they have to return the laptop or they can take it? If they have to return the laptop, then it will come under this rule, which is use of movable asset. If they don't have to return the same, then it will go to the preceding slide, which is transfer of movable asset. First, understand the difference. To be very fair to this thing, most of the students do not know the difference between use and transfer. Without this, there's no point in reading this rule at all. So, in the case of use of mobile asset, if it is laptop and computers, taxable value will be zero. Laptop and computers, zero. This is because the government wants to encourage use of laptop and computers. Due to COVID situation, a lot of people have been given laptop and computers for work from home. Should they have to pay tax? The answer is no, because of use of laptop and computers will have a taxable value of zero. Any other movable asset, as already discussed, you can easily come to a conclusion of 10% straight line. We discussed about this enough number of times. 10% straight line or higher charges as reduced by any amount paid by the employee. Can we take use of motor car as use of mobile asset? You can see the left hand side of the site. The law makes it very clear. If rule 3.2 is applicable, then you should go only by rule 3.2. Don't come under this rule. Similarly, we have already seen at the time of rule 3.1, furnishings are going to be valued under 3.1. Again, go with 3.1, don't come to 3.7. So if you have specific rules covering that, go by that rule. This is for use of mobile asset. Transfer of mobile asset is a very interesting point. Just I have to very careful look at this particular point. Perquisite in respect of transfer of movable asset. That means here the ownership is transferred to the employee. So in such circumstances, how to value the perquisite becomes a question. So take the cost to the company, then you have to reduce depreciation at the prescribed rates. The prescribed rates are given here. I given in the prescribed rates here. For each of the completed years during which employer is put asset dues. Very important, during the completed years. That means if I give the laptop on 1st of May, 1st May to 30th April will be taken as one completed year. So for every completed year, you should apply depreciation. If there is no completed year, depreciation will be zero. If there are 1 year and 11 months, 1 year depreciation. It has to be taken only for completed year. The step 1 minus step 2 is the value at which the employee is supposed to sell the asset to the employee. So this you can call it as a deemed sale value of the asset. Subtract the amount paid by the employee. If the amount paid by the employee is zero, step 3 will be the taxable value of the asset. If step 4 is less than step 3, then the difference between 3 and 4 will be the taxable value of the perquisite. So the rate which you have to adopt, computer and electronic gadgets, 50% WDV. Motor car, 20% WDV. Other items, 10% straight line. What is very important to note here, first one is computer and electronic gadgets. Examiner gives refrigerator. So many students apply 50%. Refrigerator, you cannot apply 50% because refrigerator is not an electronic item. It's only a electrical item. Electrical items will come at a 10%. If microwave is given, you should apply 10%. If mobile phone is given, you can apply 50%. If PlayStation is given, you can apply 50%. They are all electronic gadgets. But here, if refrigerator, microwave, all your household so all those things will come only under other items. You should differentiate between electrical and electronic items. Electrical items will come under 10%. Electronic items will come under 50%. And they also now started using electronic gadgets. So therefore, you have to be very careful with this particular point. So take step 2. 3 is the deemed value, actual price, taxable value. Deemed value is going to be added by applying depreciation at the prescribed rates for completed years. If the completed year is not there, nothing will be reduced. If 1 year 11 months, 1 year, 2 years 8 months, 2 years only. So what we
Mm.
take a small break now. Just after 2 minutes, update join for that.